Imagine you want to buy a busy neighborhood coffee shop. How do you figure out a fair price for it? You wouldn't just throw out a random number and hope for the best. Instead, you'd look at the business as a financial machine. You put cash into this machine today to pay for things like espresso beans, new equipment, and employee salaries. And the entire purpose of this machine is to spit a continuous stream of cash back out to you. If you can add up all the cash it will generate over its lifetime, in today's dollars, you found its intrinsic value. A business's true worth is based entirely on its mathematical ability to produce that future cash. It doesn't matter how trendy its logo is or how much hype it gets in the neighborhood. When we look at the stock market, the exact same logic applies. Stocks are simply sliced up pieces of ownership in real-world cash machines, just like that coffee shop. But something strange happens when people open a brokerage account. They abandon the straightforward coffee shop math, and they become completely obsessed with the flashing numbers on the screen, the constantly changing daily price tag. Confusing a stock's daily price tag with its actual underlying value is the most common trap for new investors. It leads directly to bad decisions. To see why that happens, let's look at two flawed ways people try to buy our coffee shop. First, there's the approach of the speculator. A speculator buys the shop without ever looking at its financial books. They don't care how much coffee is actually being sold. They buy it solely hoping someone else will come along tomorrow and pay a higher price. That pure guesswork is dangerous. In fact, rampant speculation, buying shares just because prices were going up, drove the massive stock market collapse of 1929. Then there's a second flawed approach, the technical analyst. This is a diagram tracking foot traffic outside the building. A technical analyst will stand across the street and draw complex charts based on these outside movements, trying to guess future trends, without ever stepping inside to see if customers are actually buying anything. Both the speculator and the technical analyst fall short trying to predict short-term price movements. Neither takes the time to measure the actual long-term health of the business itself. That brings us to the value investor. This approach was born out of the 1929 crash, developed by financial pioneers Benjamin Graham and David Dodd. They established 3 strict rules. Rule 1. Accept that stock prices will always be volatile. The market is prone to unpredictable mood swings, causing the asking price for our coffee shop to bounce around wildly from day to day. Rule 2. Ignore that noise. You must maintain a strict focus on the underlying business fundamentals, the steady, actual cash flowing through the register. And Rule 3. Wait patiently. You only buy when the market is feeling depressed and offers you the business for a fraction of what it's really worth. This requires serious discipline. Most traders get swept up in the noisy, chaotic environment of the trading floor, making snap decisions based on fear and greed. A value investor's true advantage is the ability to keep a cool, mathematical head while everyone else acts on raw emotion. Because value investors buy based on math, they rely on a built-in protection mechanism called the margin of safety. This chart compares value and price. If you do the math and calculate that the coffee shop's intrinsic value is exactly $100,000, you do not pay $100,000 for it. Instead, you wait until the market has a bad day, panics, and offers you that exact same $100,000 business for only $50,000. This massive gap between the price you pay and the value you receive is your margin of safety. This buffer acts as a shock absorber. It protects your investment. So even if your original math was slightly off or the business hits unexpected bad luck, you are far less likely to lose your money. There is a persistent myth that value investors are only allowed to buy boring, mature, or unpopular companies. That simply isn't true. If a highly popular, fast-growing tech giant suddenly goes on sale for less than its intrinsic value, a value investor will absolutely buy it. In fact, some of the greatest investors in history have built immense wealth by capitalizing on these high-profile opportunities when the market misprices them. It all comes down to knowing the clear mathematical difference between a stock's current price tag and its actual intrinsic value. At its core, value investing is simply intelligent investing. It is the discipline of paying less than the value you receive in return.